The past week was another eventful in dull summer markets. We had two major events: the minutes of the July FOMC meeting and the annual Jackson Hole Symposium. The minutes of Federal Reserve's July meeting certainly increased speculation of an impending tapering of bond purchases. Federal Reserve Chairman Ben Bernanke used the 2012 meeting in Jackson Hole as a platform to make his case for what is better known as QE3. This year, with the Fed chairman absent, the tone was different as some of the discussion papers questioned the value and efficacy of the central bank's unconventional stimulus policies. There are two moving parts involved in what Fed Chairman Bernanke has been describing. First of all, the Fed is indicating that it will keep short rates low for a couple more years. A low Fed funds rate will keep interbank short-term interest rates low. Low short-term rates are intended to support growth. However, these low rates are not being passed on to consumers by the banking monopoly. All it is consistently passing on to consumers is exceptionally low bank deposit rates. Banks are taxing their customers to fund themselves and rebuild equity capital. Secondly, tapering means the Fed will reduce the massive monetization of the huge government budget deficit. This means the deficit will have to be funded by sources other than the Federal Reserve. The Fed is in the unique position of being able to literally print money to buy long-term government and agency paper. With the Fed out of the picture, one wonders who will take its place. We are headed into uncharted territory and the consequences could be unimaginable. Moving to markets. Good real economy news comes out of China, US and Eurozone. China August manufacturing PMI came out stronger than expected. Activity in the US factory sector rose to a 5-month high. The housing data was disappointing though. And the same with the weekly jobless claims. On the other hand, UK and Eurozone manufacturing PMI shows emergence of green shoots. Emerging markets are the real talking point these days. India's rupee and Turkey's lira both crashed to record lows on Thursday following the US Federal Reserve releasing minutes. Brazil's currency slid to record lows that prompted the president to hold an emergency meeting with top economic officials to check the Brazilian real's slide after it hit a 5-year low against the dollar. The central bank chief cancelled his trip to the Fed's Jackson Hole conclave in order to monitor market activity amid reports Brazil is preparing direct intervention to stem capital flight. Brazil has excessively relied on futures contracts to defend the real, camouflaging the erosion of Brazil's $374 billion reserves. But this has not helped to deter speculators. They are moving currency intervention off balance sheet. But the net position is deteriorating all the time, said a top economist. Some emerging market countries have been dispensing reserves to defend exchange rates, with holdings down 8 PC in Ecuador, 6 PC in Kazakhstan and Kuwait, and 5.5 PC in Indonesia in July alone. Turkey's reserves have dropped 15 PC this year. Comparisons to 1997 Southeast Asian crisis quickly come to mind, but I would still not hastily run to such a conclusion. To put in perspective how the major emerging market currencies have fared in recent times, I would take the Bloomberg US Dollar Index for BRIC currencies. This index is an equally weighted basket of INR, IUB, BRL and CNY. It rose for a second week and touched its lowest level versus the dollar since June 2010 on concerns of an imminent end to Fed's quantitative easing strategy. Since the start of June, this year retail investors have pulled $18 billion from emerging market bond funds, which is about 1/3 of the amount they had invested since 2009 according to fund tracker EPFR Global. Until I meet you next week with more analyses, this is wishing everyone a nice week ahead. Akay Garamati, financial market professional.